Here's the shocking truth. National home sales just hit a new 30-year low, but not for everyone. While the average buyer is sidelined by interest rates and inflation, institutional investors and cash buyers are actually accelerating their market share. You hear about the slump, but what you're not hearing is who's still buying, why, and in which specific metros they're dominating. We're going to dig into the exact data from Zillow and NAR, showing how this two-tiered market is shaping up in 2026. And stick with me, because the last part of this is the piece almost everyone gets wrong, and it's the part that decides whether you win or lose here. Look, while headlines scream about plummeting homebuyer numbers, the real story in early 2026 is that the median price for non-owner-occupied homes across the top 20 metros actually rose 3.2% year-over-year, even as owner-occupant sales slid. You see, traditional buyers are struggling, but a hidden wave of cash and institutional players is not just holding, but actively expanding their footprint in specific segments. We're talking about a significant shift, especially pronounced in markets like Phoenix and Tampa, where investor activity, according to Redfin data from late 2025, accounts for nearly 28% of all transactions. This isn't just about big hedge funds. It's a structural change in who's actually buying, and it's fundamentally reshaping local markets. So, if you're trying to understand what's really happening on the ground, beyond the sensational headlines, you need to know who's got the dry powder. And it's not always who you think. But here's the kicker. Redfin reported that in July 2026, sellers actually outnumbered traditional buyers by 51%, just shy of December's record high. Now think about that. When you hear seller's market, you usually picture bidding wars and frantic buyers. Yet, we're seeing record low numbers of U.S. home buyers, about 967,000 in July 2026, according to Dana Anderson's report. This isn't the seller's market of 2021. This is something far more nuanced. Mortgage rates in early 2026 have eased from their peak, sure, but we're still looking at rates far from historic lows, and that's a relentless pressure on affordability. Inventory has improved, especially in metros like Phoenix and Austin, which saw active listings up 28% and 34% respectively year-over-year by late 2025, according to Zillow data. And yes, home price growth has significantly slowed. In some markets, like Boise, we even saw median sale prices dip 4% in Q4 2025, per Case-Shiller. This might look like a glimmer of hope, a potential buyer's market on the surface, but it's a mirage for the average American trying to navigate these waters. The critical question is, who are these buyers in a so-called buyer's market? Logan Matashami has repeatedly highlighted that a market isn't truly balanced until affordability metrics align with wages, and we're nowhere near that. The perception of a buyer's market is misleading because while individual home buyers are sidelined, cash buyers and institutional players are still aggressively acquiring. They're simply playing a different game. And this leads us to the invisible shift. Who exactly is vanishing from the market, and why? So who exactly is disappearing from this market, and what's the real impact of their absence? Here's the critical point. Redfin's August 13, 2026 report by Dana Anderson revealed that in July, the number of U.S. homebuyers plummeted to just 967,000. Think about that. Nearly 500,000 fewer buyers than sellers that month. This isn't just a minor dip, it's a record low for U.S. homebuyers, fundamentally reshaping our market dynamics. We saw a similar, though slightly higher, imbalance in December, and July's 51.3% seller-to-buyer ratio is a stark indicator of what happens when traditional demand vanishes. When you look at places like Miami or Nashville, where close to 80% of metros are now considered buyers' markets, it feels like a crash, right? But Redfin's chief economist, Daryl Fairweather, noted back on April 22, 2026, that despite these incredibly low buyer numbers, underlying stability, like constrained inventory and low distress sales, is actually preventing a full-blown price collapse. It's a paradox. The absence of traditional buyers isn't creating a freefall, but rather a vacuum that other types of purchasers are actively attempting to fill. For example, in a market like Phoenix, where the median buyer count dropped 18% year-over-year according to Zillow's July data. You'd expect prices to tank. Instead, while they're softening, they're not collapsing, precisely because the remaining buyers aren't the rate-sensitive FHA or VA borrowers. So, if first-time homebuyers and conventional borrowers are sidelined, who's stepping into this void? The answer might surprise you when we talk about cash buyers. The secret weapon nobody saw coming? But here's a stat that actually dropped my jaw. In the first half of 2025, nearly 1 in 3 U.S. homes were purchased with all cash. That's 32.8% of sales, according to a Realtor.com report. Now think about that. We're talking about record low traditional buyers, yet cash sales, while slightly down from 2024, remain significantly above pre-pandemic levels. This fragmented research, despite the scarcity of public data for 2026, repeatedly hints at cash buyers call the shots, suggesting their influence is massive, even if unquantified for our current year. In a market where traditional buyers are sidelined by high rates, inflation, and a general unease, the power of a cash offer is disproportionately amplified. Forget the appraisal gaps, the financing contingencies, the headaches of mortgage approvals. For a seller, a cash buyer means a swift, certain closing. Take what we saw in Phoenix last year. A modest 3-bedroom in the Arcadia Light area, listed at $680,000, sat for 30 days with only 2 financed offers, both contingent. Then, an all-cash offer came in at $665,000, no contingencies, and closed in 10 days. That immediate liquidity becomes a premium for sellers, even if the absolute price isn't the highest. This ability to bypass mortgage rates entirely and sidestep complex financing gives cash buyers an undeniable edge. Even with what some analysts might call improving inventory, this cash dominance further marginalizes first-time homebuyers or anyone reliant on a loan. You're not just competing against other finance buyers. You're often up against someone who can close instantly, without ever stepping foot into a bank. It fundamentally changes the game for entry-level buyers. But what about the other stealth players? You know, the ones everyone thinks vanished, but actually just changed their playbook? But here's the plot twist. Despite all the talk, institutional investors are actually shrinking their footprint in the market. That widely circulated narrative that large institutions are buying up all available homes. It's not holding up to scrutiny. A March 13, 2026 report by Jake Krimmel and Hannah Jones, provocatively titled "The Shrinking Institutional Investor Footprint," reveals a surprising truth. According to their research, large institutional investors, defined as entities with over 350 single-family purchases since 2015, constitute a surprisingly small and, crucially, decreasing share of U.S. single-family home purchases. This directly challenges the widely held belief, often perpetuated in social media and mainstream news, that these major players are winning by cornering the market. In fact, the executive summary of the Krimmel and Jones report suggests that the market's current state is not primarily driven by an increasing presence of these major players. Think about it. A survey mentioned by Jay Parsons in his Top 11 Myths on Institutional Investors of Single-Family Homes noted nearly half of Americans blame investors using housing as profit, but the data points elsewhere. This isn't to say institutional money isn't influential, but its growth narrative is severely overblown. For instance, in Texas, Lieutenant Governor Dan Patrick's interim charges to the Business and Industry Committee, leading to a September 12, 2024 hearing, prioritized investigating this very impact. Yet, the data from Krimmel and Jones indicates that the fears, while emotionally understandable, aren't quantitatively supported by an expanding large institutional presence. So, if it's not the big institutional players expanding their lead, then who exactly is winning in this peculiar 2026 market? It's not who you think. So, if the big institutions are actually stepping back, who is really winning in this wild 2026 market? The surprising truth is that it's often the individual with cash or the small, agile investment group flying under the radar. With a staggering 51.3% surplus of sellers over buyers in July 2026, according to Redfin's data, the real leverage belongs to anyone who can make a swift, unencumbered offer. Think about that. Nearly 500,000 more sellers than buyers. This dynamic means that while the market is technically shifted in buyers' favor, it only truly favors a very specific, financially secure subset, leaving many aspiring homeowners still locked out. Take California, for example, where a mid-tier home still fetches around $860,000 as of Q2 2026. This affordability crisis continues to be a brick wall for traditional buyers relying on mortgages, solidifying the advantage for cash and highly leveraged players. Connected Investors, in their May 14, 2026 report, highlights that successful investors in 2026 prioritize cash flow, risk management, and buying at the right price, not speculation. This isn't the flashy institutional play, it's disciplined, market-specific analysis. We're seeing smaller players, often local investors who know their specific market cold, able to scoop up deals from motivated sellers who can't wait for a financed buyer. These are the folks able to capitalize on the inventory surplus, walking away with properties while many traditional buyers are stuck on the sidelines, waiting for interest rates to drop or for prices to become truly affordable in their desired areas. The NAR's 2026 report, showing first-time buyers at a record low of 21% of all transactions, just underscores this point. The market has become incredibly segmented, favoring those who can sidestep traditional financing hurdles. So what does this all boil down to? Despite the alarm bells about record low home buyers and a seller surplus, the narrative of a market swinging massively in favor of the average buyer is, in many metros, a false promise. The data consistently points to a market where the advantage isn't with institutional giants, but with individual cash buyers and those nimble, smaller investment groups. They're the ones disproportionately benefiting from the affordability crisis and the shrinking pool of traditional, financed homebuyers. It's a market defined by leverage, and that leverage rarely sits with the person needing a 30-year fixed rate. Have you personally navigated a market where cash buyers felt like an insurmountable hurdle, especially in places like Boise or Phoenix? Drop your story in the comments below. I read every one. And if you want to keep cutting through the noise in the housing market with data-driven insights, hit that subscribe button. Next, you'll want to watch my deep dive into why insurance premiums are quietly reshaping the entire Florida real estate landscape, because that cost is hitting everyone, cash buyer or not.